So now we're going to talk about one of the interesting debates in strategy. That is shareholders versus stakeholders, right? And so you have to ask yourself, what is the ultimate goal of the firm? To enrich shareholders or enrich stakeholders? So right now in this video, I'm going to talk about shareholders. Okay? So our friends in neoclassical economics, starting with Adam Smith, of course, would believe that a corporation is the most responsible, the most ethical even, and certainly the most efficient when it maximizes the wealth of the owners. Okay? Now, in a modern economy, not in Adam Smith's time, we would be talking about maximizing the wealth of shareholders. When Adam Smith was writing this, remember, there were not the large corporations that we have today, so most firms were owned by mom and pop, family type businesses. And so maximizing wealth of the owners meant enriching the family business owner. But let's ask a question, first of all. You know, irrespective of whether maximizing shareholder wealth is the most ethical thing to do, let's think, and if you're interested, by the way, in whether shareholder maximization of profit is the most ethical approach or not, I encourage you to look at some of my videos in business ethics, my business ethics courses. But let's talk about it from maybe more of a strategic orientation. Why would that even be a reasonable goal, forgetting ethical? Well, first of all, we would think that since board members are legally obligated to pursue shareholder interests, then by law, they should be maximizing owner profits. You should watch some of my videos under corporate governance for a little more detail here. Furthermore, to replace assets, a firm must continue to earn a return on capital that is greater than the cost of capital. Okay? So if you cannot afford to maintain and upkeep your equipment and your manpower, then you will fail as a firm. And this becomes especially germane when competition heats up. And furthermore, to survive acquisition, a firm must have a greater stock market value than the breakup value. Let me think of some examples here, right? If a firm's stock price drops too low, then it's much less expensive for a competitor to buy that firm. Okay? I think about Kraft Heinz, right? Kraft Heinz's stock had dropped a little bit, and of course, Heinz Company, along with 3G Capital, bought up Kraft. Okay? Because had Kraft's stock price been higher, then they would have not been acquired so easily by Heinz. Okay? So when stock price drops too low, it's cheaper to buy those firms. So therefore, they should try to distribute their profits through to their owners, to their shareholders, through the higher stock prices to survive acquisition. Now there's of course some limits to this approach, right? There's a blatant bias towards the short term, right? Stock prices are a very short-term thing, right? Stock price can go up $10 one day and be down $100 the next. So bias is the short term. And you think about it as an owner. How many of you own stock? How many of you that own stock would be really happy if the CEO said, you know what, owners, you know, our stock price is going to plummet 50%, but don't worry, in the next 10 years it's going to go up in value. No, you wouldn't be happy with that at all, right? You want consistent year after year gains in the stock price itself. So that tends to favor the short term. It's an oversimplification. By just saying profit is the best measure of strategic success, that's an oversimplification, right? And it does tend to overlook things like research and development and long-term horizons. And of course, the other part is the consequences are there for everyone to see. It's usually a pretty good indicator of how well a firm is doing and how successful their strategy is just by looking at how they distribute their profits to their owners. So you don't really have much ability to hide your success of your strategy. Now, in the next couple videos, we're going to talk about stakeholder models, and then we'll talk about the stakeholder approach. So I'm looking forward to seeing you then.